Rate cuts can be very beneficial for utility companies, and Hydro One may just be the perfect example of what is to come. Fasten your seatbelts, folks. This is going to be a good one. This is a deep dive into Hydro One and why it's positioned to shine big time in a rate-cutting environment. We are going to explore why utility companies do so darn well in a rate-decreasing trend, and we will also look specifically at Hydro One to see if this holds true in their case, or perhaps they may even be leading the pack. You will want to stick around for that and so much more. Since 1999, Hydro One is Ontario's largest electricity transmission and distribution provider, supplying power to nearly 1.4 million customers. They have, without a doubt, been a cornerstone of Canada's utility infrastructure. As an investment, they have been a solid choice for Canadians to gain access to the sector. Now, with rate cuts all around us, they are set to make their investors a very respectable total return. You may ask, why do utilities do so well in a rate-cutting environment? Utilities tend to carry a lot of debt due to their capital-intensive nature. Of course, the pressure for more renewables has certainly helped many utility companies add even more debt to their already high debt. When rate cuts are occurring, borrowing becomes much cheaper, and this helps the servicing of their debt, well, big time. And this in turn increases their overall profits, which is never a bad thing, that's for sure. Additionally, lower rates makes the reliable dividend payments from utilities much kind of like REITs, more attractive compared to bonds, GICs, and savings accounts. Hydro One in particular is well positioned because it's a regulated utility, meaning its earnings are relatively stable, so we are expecting a pretty low beta on this one. This is just what investors tend to look for when uncertainty looms. The current and potential future rate cuts could make Hydro One an even better choice for those looking for a safe haven with a steady income. Speaking of a safe haven, a sub to the channel is the safest way to ensure you stay up to date with future content. Right now, Hydro One is proving their resilience. Despite inflation and, of course, all of the rising costs that came with it, they've maintained a strong balance sheet, and they continue to deliver steady earnings. And now, of course, we are moving into that rate-cutting season, and that is going to be a huge thing for Hydro One for sure. For this deep dive, we will be using their Q2 quarterly results, which covers their data up until June 30th of 2024. Some of this data is not going to fully reflect the effects of the rate cuts, but no worries. We're going to see that in the returns for sure. Going through that report, I did find a few highlights that I wanted to share with you guys. They reported an increase in their EPS with 49 cents in Q2 compared to 44 cents for the same period in 2023. This year-over-year increase demonstrates strong financial performance, largely attributed to higher revenues from approved 2024 rates and higher average monthly peak demand. They made significant capital investments of $818 million during the quarter, up from $649 million a year ago. Additionally, Hydro One placed $526 million worth of new assets in service, compared to $413 million last year, reflecting their commitment to infrastructure growth and service reliability. Finally, Hydro One was once again recognized on Corporate Knights 2024 list of 50 best corporate citizens in Canada. This recognition highlights the company's ongoing commitment to sustainability and reinforces its strong ESG credentials. Thus far, I'm almost already sold on this company. But before we bring up the sale, I need to get in touch with the numbers. You know what that means. We need to call on the prince of percentages, the maestro of multiplication, the one and only Mr. Math. We will, of course, start off with a little bit of surface data. At the current time of recording, their current value comes in at $45.05. And they have a market cap of $26.99 billion. That beta, yep, very, very, very low as we were thinking, 0.34. Meaning they're about a third as volatile as the market average. Their earnings per share coming in at 1.87, price to earnings ratio 24.08. Amongst their peers, the average comes in at 17.70. Some of those peers, of course, include Fortis with a PE ratio of 19.4, Emera with a PE ratio of 21.5, and Brookfield Renewables with a PE ratio of 16.4. Looking at their price to book ratio, that comes in at 2.30. The average amongst those same peers comes in at 1.60. Their return on equity, that's coming in at 9.61%. Return on assets, 3.57%. These numbers are absolutely fine. Let's dive a little deeper and take a look at their cash situation. They have a revenue of $8.11 billion, and their earnings came in at $1.12 billion. Now, those earnings are projected to grow by 6.62% per year. Profit margin, 13.8%. Now, their free cash flow is in the negative at negative $353 million, but that operating cash flow looking very healthy at $2.62 billion. When we take a look at their fair value, so their current value was $45.05. Using a discounted cash flow model, we do get a fair value of $40.84. So that actually paints them as slightly overvalued at 10.3%. In fact, when we look at their 1-year target, well, the analysts are looking at $44.17. So that's actually a drop of 0.3%. You have to take this projection with a grain of salt, as it was made before the rate cutting season began. And I have a feeling once we get a new report, so that's like November 7th actually, so it's not that far away, I think we're going to get a different tune. Okay, let's peel back another layer and look at their dividends and returns. When it comes to dividends, they have a yield of 2.761%. That is a quarterly dividend of 31.4 cents per share. Payout ratio on that, 64.35%. That dividend has been increasing. Their 5-year average dividend increase, that comes in at 5.83%. Switching over to the returns, on their 3-year return on investment, that comes in at a nice, healthy looking 52.51%. Total return, 62.23%. That's not too shabby. On their 1 year, that return on investment comes in at 21.56%. Total return, once we factor in the dividends, 24.85%. So that, once again, that's not bad at all. One thing you will notice with this data is that they weathered the bear market and the aggressive rate hikes rather well, and that goes to show the stability that can come when a utility is highly regulated. Of course, there are exceptions to that rule. Okay. Let's take that final step and peek in on their debt data. They have a total debt of $16.38 billion. Their total equity coming in at $11.99 billion. That makes their debt to equity ratio 136.6%. Now, this debt to equity ratio, it has increased from 129.8% to that 136.6% over their last 5 years. So they've kind of been moving that in the wrong direction. They do have some cash and cash equivalents. That totals in at $74 million. Looking at their short term, their assets come in at $1.39 billion, liabilities $3.46 billion. On their long term, they have assets of $32.80 billion, liabilities of $18.75 billion. Overall, their debt is actually not that bad for a utility company. High debt is part of the game. I know that I said their rising debt to equity ratio was a move in the wrong direction. However, if they are taking on good debt to finance a stronger future for the company, it's not always so bad. A lot of times if you do have bad debt that's being added to your balance sheet, you're also going to run into things along the lines of share dilution. In this case, we have no share dilution, so I'm really suspecting that this is pretty good debt. And just to be clear, you can have share dilution and good debt at the same time. I'm just wanted to point that out. Don't want anyone to get confused on that one for sure. Okay, I do believe we have enough data to formulate the final verdict. I am overall bullish on utility companies as we move deeper into rate cuts, and Hydro One is definitely one that I like. They have a solid record of consistent growth, with a moderate dividend, making them a very good utility sector total return stock. With regulation, this is a company that has demonstrated stability and reduced volatility, as their beta, of course, has clearly shown. I see this as a great option for a long-term hold. And I think this stock will work with most portfolios. It is good for both the long-term investor and for the total return investor as well. Of course, the income-focused investor will more than likely pass on this one as there's not a lot of income. However, it could still be attractive for a more mixed income and growth investor. I also think if you're doing your research on this one, waiting for that next quarter to drop is not a bad idea, as these numbers are slated to get better for sure. Nonetheless, if you are interested in Hydro One, don't forget to put in a whole heaping helping of due diligence before you place any of your hard-earned money on the table. Well, let's continue that learning journey by checking out this video on CPP investments. Thank you for watching, and I will see you in the next video.